Scope of business economics. Scope means what are the areas covered under economics, what kind of topics the business economics covers, what are the areas comes under the umbrella of business economics. So the first one is demand analysis. Demand is what? Demand is the amount of product consumers are ready to buy at a given price, is called as demand. Suppose the consumers are ready to buy a particular product, suppose say an apple is 20 rupees per piece, then per apple 20 rupees. So if the consumer is ready to buy the apple at rupees 20, then we can say that there is a demand for apple. If they are not ready to buy at 20 rupees, then we say that there is no demand for apple at that rate. So demand means the amount of or the quantity of the goods the consumers are ready to buy at a given price is called as demand. So demand analysis. Demand analysis means analyzing the expected demand of the market. Suppose a demand may increase, demand may decrease based on the situation, seasonal variation and many other conditions, taste and preference of the consumers, etc. So we have to analyze the demand, examining consumer behavior and factors influencing demand for goods and services. We have to examine the consumer behavior. Examining means the systematic investigation, how consumer behave. Suppose if we are reducing the price, what is the behavior of the consumer? Suppose if we are selling a detergent for rupees 100, if we are reducing the price to 80 rupees, then how the consumers are behaving, whether they are increasing their purchases or they are buying the same quantity. We have to analyze this thing. Then we have to take into factors the influencing factors demand for goods and services. Many factors influence the demand. The first factor which influence the demand is the price. It means price determines the demand. If the price is low, demand will be high. If the price is high, demand will be low. So price is the basic determinants of demand, but there are other determinants also we will discuss in the coming topics. But here demand analysis means complete examination of the consumer behavior. What is the response of the consumers to a change in price? If we are increasing the price, how the consumers are behaving? If we are decreasing the price, how the consumers are behaving? We have to analyze this thing and we have to find out the determinants of demand for a particular product, and we have to estimate the demand to be going to be happen in the coming future. So demand analysis helps the business to maintain the appropriate inventory, because if you do not have a proper demand analysis, you may not be able to have proper stocking, because if you don't know what would be the expected demand or expected sales of your product, you could not maintain the stock. Suppose if you are if your regular sale is 1000 unit, but next month suppose because of some reason the sale is going to reduce, so you expect 800 unit, so you can produce 800 unit only because you have expected 800. But if you don't analyze the expected demand and if you produce only 500, then you will go out of stock, and if you produce more than 1000, then you will be overburdened with the stock. So demand analysis is very much helpful in maintaining the stock level. Next one is production analysis, analyzing the production process, cost and optimal resource allocation. Production is the conversion of raw material into finished products. Production means conversion of raw material into finished product. We utilize the raw material, we process it and we convert into finished product. So production is the main part of the manufacturing company. The main profit to the manufacturing company comes from the production. So production has to be done keeping in mind demand. Here we discussed that estimating or predicting the demand is very much important. For what? for production, because if we don't estimate what should be the expected demand, then we cannot give orders to the production department. Suppose in the summer season, demand for ice cream will go high. For ice cream, the demand for ice cream in summer season will go high. The demand for refrigerators will go high. The demand for air conditions will go high. Suppose we take the example of ice creams. So if the summer season is coming and we don't analyze what is going to be the demand of the next month, then it is very much possible that we may produce less or more quantity than what actually required. So it is very much essential to find out what should be the demand, so that we can give the orders to the production department to produce that much of quantity and optimally allocating the resources. Optimal resource allocation means the resources should be utilized in such a way that it should not do any wastage, nor it should not destroy the quality of the product. The quality of the product should not be destroyed, and at the same time the wastage should be avoided. Both things should be keep in mind while optimally allocating the resources. Third one is market structure and pricing. Studying market structure and determining optimal pricing strategies. Market structures means the structure of the market wherein there is a single seller, two sellers, three sellers, or a combination of sellers. There is a different markets. We will have this concept in later units. So market structure, studying and determining the optimal pricing strategies. Suppose if we study a particular market structure, suppose perfect competition. Perfect competition is a market where there are large number of sellers and large number of buyers. Large number of sellers are there and large number of buyers are there in the perfect competition. So if we want to study the market structure of that perfect competition and determine the optimal pricing strategies. So in a perfect competition, the prices are normally homogeneous. It means all the sellers will fix the same prices, more or less the same prices. So we have to study the market structure so that we can study the market structure and we can optimally design the pricing strategy. Pricing strategy means what kind of price we should fix. A price is the amount of product paid by the consumers to the sellers. Cost is different and price is different. Cost is the amount which is incurred by the manufacturer to produce the product. Suppose to produce a pen, the cost is rupees 6, but the selling price they are fixing at 10 rupees. So 10 rupees is the price, 6 rupees is the cost. The difference between 10 rupees and 6 rupees is the profit to the manufacturer. So this is the pricing strategy. So pricing strategy can be majorly there are two type of strategy: skimming pricing and penetration pricing. Skimming means charging very high prices in the initial stages of the product so that you can achieve lot of profit in the initial stage. Then penetration pricing means charging the low prices at the initial stage, because you are penetrating. Penetrating means you are entering into the market. You are just entering into the market, so you are keeping minimum price because you are starting as a new seller or as a new company. So you will charge minimum price and later on you can increase the price. So based on the market structure, based on the market competition, you can choose the pricing strategy. And fourth one is risk analysis. Assessing risk and uncertainties associated with business decision and developing risk management strategies. What is a risk and what is uncertainty? These are the two basic concepts to be understood in the managerial economics or business economics. Risk and uncertainty. Risk is something which we know. Suppose if we start a business, there is a risk that we may not get enough profit or the sales will not be made. This is a risk. But uncertainty means anything which comes from nature, like calamities, or any uncertainty means any flood or sudden fire broke out in the company. This is called uncertainty. We don't know what is going to happen, is called uncertainty. So risk is, we know this much 10% risk is there in this business, 20% risk is there in this business. Risk is a known uncertainty, whereas uncertainty is an unknown risk, because we don't know when it is going to be fire breakout, when there will be a flood, or when there will be a heavy rain and the destroyment of the total stock and all. So assessing the risk and uncertainties associated with business decision and developing risk management strategies. We have to assess. Assessing the risk, assess means calculate. We have to calculate, we have to evaluate with the help of statistical techniques what is the expected risk in this business and what are the uncertainties likely to occur based on the environmental condition. So the risk analysis is also covered under the scope of business economics. And another one is investment analysis. Investment is the amount of money invested by the investors in the share market. So investment analysis generally means the analyzing the returns and risk associated with the investment. Suppose evaluating investment opportunities and capital budgeting decisions. Investment opportunities means the kind of opportunities available to the business. A business may have number of opportunities available. Suppose it can invest in the share market, or it can invest in the bank, or it can invest in the trading, or it can invest in manufacturing. Many opportunities are there. Several projects are available for the business to invest. So we cannot blindly invest wherever we want. We have to first find out the number of investment opportunities available to us. Suppose we have 4 projects available: project A, project B, project C, project D. There are 4 projects available to us. Then in this project, this much is the capital requirement. Capital means the total amount of investment we made at the beginning is called as capital. So suppose for project A, this much of capital is required. For project B, this much. Project C, this much. And project D, this much of capital is required. So we analyze this much of capitals are required and what are the risks associated with those all projects and what are the expected profit from those projects. So after carefully analyzing all the projects, we will decide to invest in that. And capital budgeting is also comes under business economics. Capital budgeting means budgeting in the long term assets like big machineries, plants, investments, or land and building, etc. So capital budgeting decisions are not easy to take. We have to take into consideration several factors before taking the capital budgeting decision. Suppose in capital budgeting we have the average rate of return or payback period. Suppose if you are investing in a project 1 lakh rupees, 20,000 you have to pay 20,000 every year. 5-year project it is there. 1 lakh rupees is the cost of the project. 20,000 you are paying each year, but you are receiving suppose 40,000 each year, paying 20,000 but receiving 40,000. So you will receive total 1 lakh in how many years? First year you will receive 40,000, second year you will receive 80,000, and remaining 20,000 you will receive within half year. So within 2.5 years you are receiving the total invested amount. So this kind of capital budgeting decisions are very much important, and it can be done with the help of various tools and formulas given by the managerial economics techniques. So investment analysis is one of the major scopes of the business economics. And another one is government policies and Regulation. Assessing the impact of government policies and regulations on business operations and strategies. We know that a business organization cannot run separately. It runs in a group of market and it has an influence of the government bodies also. It cannot separate itself from the government rules and regulation. Government will certainly impact, or governments will certainly influence the business markets, because the government are the rule makers and they have the authority to regularize the business firms. So we have to analyze the impact of government policies and regulations on business operation and strategies. Suppose the tax rates, VAT tax, sales tax, import duties, export duties, these are all taxes and regulations governed by the government of India or particular state governments. So these kind of restrictions or these kind of regulations, taxation have an impact on the business. So we have to study that way also. So business economics covers the government policies and regulations analysis also. Now let us have a brief summary of the conclusion. Business economics plays a crucial role in aiding managerial decision making and solving practical problems. Aiding means helping or assisting. We are continuously discussing that business economics is very much helpful, very much vital, very much crucial for solving or aiding or assisting the managerial decision making and solving practical business problems. There are several problems in the business we have to solve with the help of managerial tools and techniques. So its nature, including its microeconomic foundation, applied orientation, normative and positive analysis, interdisciplinary nature, and dynamic adaptability provides a comprehensive framework for addressing the challenges faced by firms in today's dynamic business environment. The microeconomics nature of the managerial economics is very much helpful because it completely understand a particular firm in a detailed view.